Today, we're going to analyze a real mortgage scenario step by step and decide whether this borrower would be approved or denied. And I want you to watch carefully because this is exactly how underwriters think behind the scenes. Most people guess whether they qualify. Professionals calculate it. By the end of this video, you'll understand how lenders actually evaluate a loan file, not based on opinion, but based on numbers and risk analysis. My name is Joseph Correa, and I am a licensed mortgage broker and founder of Finity Mortgage. And reviewing loan scenarios like this is what I do every single day. And one of the biggest mistakes borrowers make is assuming approval depends on just one factor, like credit score or income. You hear that all the time. It's wrong, okay? In reality, approvals are based on the entire profile working together. So today, I'm going to show you exactly how a professional analyzes a mortgage file from start to finish. Here's the borrower profile we're going to review. So this borrower has a credit score or a middle credit score of 620. Their employment, they're basically employed with a W-2 income. Their income is $2,400 bi-weekly. Their debt is $30,000 in credit cards, and they're going to occupy this property as their primary residence. And they basically want to cash out of their property. So they're going to refinance, because in order to cash out, you have to refinance unless you get a HELOC. They have in their bank account right now in reserves $2,000. Now, before we analyze it, I want you to pause mentally and ask yourself one thing: approved or denied? Most people jump to conclusions immediately, but professionals don't guess. We calculate. First of all, we go over what's called the income analysis. The first thing lenders review, obviously, income. This means that the borrower, in this case, earns $2,400 every 2 weeks. That equals roughly $4,800 per month before taxes, but that's not necessarily how income is calculated, okay? They don't guess. They use a specific calculation. So when they ask two key questions from the borrower: is the income stable? Is it likely to continue? Since this borrower is W-2 employed, that's generally considered stable income if employment history supports it, okay? So if they've been there for a year, 2 years, 5 years, 10 years, then that's pretty stable, okay? So from an income stability standpoint, this file starts off strong. Now let's go over the debt to income ratio. Next comes one of the most important approval factors: debt to income ratio, or what's also known in the mortgage industry as DTI. DTI measures how much of your monthly income goes toward debt payments. Let's assume the borrower's credit cards require about $900 per month in minimum payments, okay? Now we add the projected housing payment. For example, if the new mortgage payment is estimated at $2,000 per month, and the total monthly debt comes at about $2,900. Now compare that to $4,800 in income. That would put the DTI, or the debt to income ratio, at around 60%, and that's too high to get approved for a loan, okay? It's usually 50% or under, and it depends on the loan program. Sometimes it can be lower than that. Most traditional loan programs prefer lower ratios, okay? That means lower risk as well. Although some allow higher depending on their strengths, on other strengths such as the loan file and reserves. So right away, we see something important. This file is not automatically denied, but it does have risk, okay? And in a minute, I'm going to show you the one adjustment that could dramatically change this borrower's approval chances, because this is where strategy makes a huge difference. Now, let's look at credit. A borrower with a 620 credit score is considered fair. It's not excellent, it's not good, it's just fair, okay? But it's also not disqualifying. Many loan programs allow scores in this range, but underwriters don't just look at the score, they look at the credit profile. They evaluate payment history, recent activity, account balances, derogatory items. And if the 620 credit score is caused mainly by high balances rather than missed payments, that's actually a better scenario than a higher score with recent late payments, okay? Recent late payments, not good. Why? Because high balances can often be fixed quickly. Late payments indicate a behavior risk, which means it's not good for the lender. So the reason behind the score matters more than the score itself. So always remember that. Now let's talk about reserves. Next, we evaluate reserves. And reserves are funds that are usually left over after closing. And they're not money the borrower needs to bring at closing, okay? Let's be clear about that. It's just money that needs to be in their bank account or in a 401k or another type of retirement account, okay? They show lenders that you can handle unexpected expenses. This borrower has $2,000 in reserves. Depending on the loan program and projected payment, that may or may not be enough. Stronger reserve levels increase approval odds because they reduce perceived risk. Think of reserves as a safety cushion. The bigger the cushion, the safer the loan appears to underwriting. Now, let's talk about compensating factors, because this is something a lot of people don't even know exists. Now we look at compensating factors, strengths that offset weaknesses. Possible compensating factors include stable employment history, consistent income, low housing history, strong savings, low overall debt. If the borrower has steady employment and a solid payment history, these can always help to offset a higher DTI or lower credit scores that they may have. This is why approvals are never based on just one number. They're based on the full picture. Now, let's talk about a strategic adjustment that could change the decision of this specific loan file that we're talking about now. Here's where strategy really comes in. If a borrower paid down a portion of their credit card debt before applying, their DTI would drop. Lower DTI equals lower risk. Even reducing balances strategically, not paying everything off, just the right accounts and just the right amounts, could shift the approval process. Another possible strategy would be selecting a loan program that allows higher DTI ratios. Some programs are designed for borrowers who fall just outside those traditional guidelines. So instead of asking, will they be approved? The professional question is, what changes would increase approval probability? That's how experts think. So, would this borrower be approved or denied? And the answer is possibly, but not without strategy. So would this borrower be approved? The answer is possibly, but not without strategy. As it stands, the file shows moderate risk due to DTI and reserves, but the small adjustments that you can make, approval probability could increase significantly. And that's the key lesson here. Mortgage approvals are rarely yes or no situations. Most of the time, they're optimization situations, which means you improve the situation and you get an approval. If you remember one thing from this video, remember this. Approval isn't about guessing, it's about analyzing. When you understand how lenders evaluate files, you stop hoping you qualify and start positioning yourself to qualify. That's the difference between uncertainty and confidence. If you want to learn how to analyze mortgage scenarios step by step like a professional, I teach this entire process inside my training programs linked below. And if you want me to review your situation, comment scenario, okay? And write your numbers. I might break it down in a future video, okay? And don't forget to subscribe and like this video so that you can get more of this valuable content and you can take advantage of this by getting approved for your loan next time.